Okay, so we are now into the last section of managing and controlling your financial risk. The key numbers, and I'm going to go through a number of ratios with you, and there'll also be an exercise that you can choose to take this up if you like to calculate your ratios for your business. Now, ratios are really important because it helps to show you how you are performing, yeah, and all a ratio is one number or one metric divided by another. Well, again, I got a subsystem of the different kind of ratios. We got a profitability ratios that show you how profitability you are, or how profitable you are. We got the liquidity ratio that show you what's your current assets to current liabilities, how easy can you turn, say, assets into cash. We got an asset utilization ratio, which, as I said earlier, the only reason for asset is to make income. So you're going to measure how efficiently is your business using assets to make income. You got capital adequacy, which is more for banks anyway, but you got to have certain amount of capital in order to do business in a bank or other financial services companies. And we've got the efficiency ratio, which measures, say, things like how efficient the human resources are. For example, if you add in a number of other people to your team, or they add in sales. Let's get straight into it. So, profitability ratios really measure how profitable the business is, and it's basically the ability to generate profit, yeah, relative to revenue. So, with most of these ratios, what you're doing here is that you're dividing profit or even expense divided by revenue. So, revenue is obviously one is the numerator, one is the denominator, right? So the denominator here is always sales, the top line, and you divide in profit um, by sales. So gross profit margin, I showed you that earlier, is the gross profit divided by sales times 100. Operating profit margin is after you have the gross profit, you minus operational expenses, you get an operating profit. You take the operating profit divided by sales to get that margin. Net profit is after you take off all uh, expenses, including depreciation, amortization, whatever it might be. And you can even take off tax as well. And you get net profit divided by sales. Our return on equity is obviously ROE, is the income that you have for the year divided by sales. EBITDA is a very, very important measure for profitability, which is earnings before interest, tax, dividend, and amortization. I'm not going to go into EBITDA so much today, but you can research it. Let's get into this again. So, from a gross profit margin, I already told you, is basically the gross profit, which gross profit is revenue minus cost of goods sold, divided by revenue times 100. That tells you what kind of a margin you are making to contribute towards operational expenses. Yes, and that's really, really important because you understand that in order to be profitable in business, you got to be selling your goods and services higher than your expenses, and the gross profit just tracks the direct cost versus the sales price. Got operating profit is basically operating profit divided by revenue, also known as a return on sales. This is a good indicator of how well the business operation is managed and how risky it is. Yeah. And what you can do is compare these ratios for 1, 2, or 3 years. You're going to have an exercise to do on this should you wish to take it up. Net profit margin, as I said, net profit after tax. So not just the operating income now, is the operating income minus tax, depreciation, amortization, net profit after tax divided by revenue times 100. I give you a ratio, okay? And that's really, really important to show you on average what is the net profit margin, what is the amount of money that the business, the percentage is making after covering all expenses and taxes. ROE, return on equity, is effectively net income divided by shareholders' equity. Because ultimately, shareholders want a return for the money. And this is effectively measuring what is the rate of return. So ROE is also a rate of return. As this ratio provides investors with insights into how efficiently a company and its management team is handling shareholders' money that are being contributed. It measures the profitability of a business in relation to stockholders' equity. So this is a very, very important ratio. All right. So it's a bit of the price earnings ratio for a public limited company. But the price earning ratio, the PE ratio, has two set of factors relate to it, because you also got the EPS, the earnings per share. Now the earnings per share in a limited company is effectively what we are doing here now. We're taking the net income divided by the number of shareholders, in that case the EPS, right? I'm just giving you some. I'm telling you that you can also do the PE ratio, price earning ratio, which is effectively the EPS divided by the price. Yeah, but that's a bit more advanced strategies for now. Now, these things are also important for you if you're looking to invest and you want to choose which investment to go into. If you want to really just understand how to manage your money, you want to make sure that the business that you're investing in is going to give you money. Yeah, it's really although this is the money mastery program, you still need to understand business and business returns and measure efficiency, measure profitability, right? And EBITDA is operating income. You adding back depreciation and amortization. Okay? So you adding back depreciation and amortization because it's earnings before interest, tax, dividend, amortization divided by revenue. All right? And this calculates how much basically is generated as a percentage of the sales. It should always exclude any depreciation and amortization. And some companies use EBITDA multiple, like take EBITDA times 6 to value the company. Very, very important ratio. Our liquidity ratios are basically how, as I said earlier, how quick can you turn, say, current assets into cash? Yeah. So it measures the business ability to meet a short-term debt. You've got a number of liquidity ratios. Like the asset test ratio or quick ratio is cash plus current assets divided by current liabilities. Or actually cash plus accounts receivable, which is debtors, plus any like money market funds, etc., divided by current liabilities. That's really the a ratio that says how liquid the business is or the asset test. It's a quick ratio to say basically, do you have enough cash and cash equivalents to cover your current liabilities? And the cash ratio is obviously cash and cash equivalents of our current liabilities. And then you have the current ratio, which is a key ratio. You should always have, let's say, 1.5 times assets times liabilities. That means after you pay all the current liabilities, you still have current assets left over. This is a key ratio that bankers look for when they're looking to lend you money. And net working capital ratio is also called the current ratio, which is the current assets to current liabilities. Then you have some utilization ratio now. Remember we were looking at something called PLACE, PLACE. We're on to A right now. And asset utilization ratio shows you how efficiently, for example, are you turning over your stock, or how efficiently are you collecting money that due to you. Yeah. So this one is called inventory turnover. How quickly is it taking you to turn over your goods and services? Yeah, it shows how many times your business has sold and replaced inventory during a specific period of time. So cost of goods sold divided by inventory. Then you also got some accounts receivables. You got lots of ratios, and you can go through these ratios. Like you can look for them, you can go through them and said, capital adequacy ratio is really used in banks, etc. TA1 plus TA2 plus risk-weighted assets and all that kind of stuff. Now, risk-weighted assets is a very, very specific formula that look at the risk weighting of the assets. I'm not going to go into this right now, but I'm just showing you this for completeness. An efficiency ratio is where these ratios are typically used to analyze how well a company utilizes assets. So, for example, you can actually have assets over sales as the efficiency ratio. Yes? Or revenue over accounts receivable, etc., etc. A number of key ratios for you here. And I'm not going to go through each of these in very, very detail. Now, there's an exercise for you to calculate the key ratios for your business over the last 3 years, focusing on profitability, liquidity, and efficiency. See, as I said, we're not going to cover all of the ratios like asset tests or capital adequacy. Just for these three ratios, I want you to calculate them for the last 3 years for your business. I've already put the exercise there for you. And effectively, what you're going to do is just look at year one, year two, year three. We've given you the formula. Calculate these ratios for the next three over the last 3 years to see how efficiently you have been or how profitable you have been. Okay. So the first one is obviously profitability. This is actually liquidity, and this one is asset utilization. Then we have efficiency ratios as well. So what I said here is that I really want you to understand these ratios for your business over the last 3 years. And that brings me to the end of the how to manage your financial risk. How to manage your financial risk means that you understand the information behind your business, that you can make decisions based on information, your financial intelligence. So you know, for example, where you need to improve. Okay. I know it's called managing money. We're going to go into the next big section coming up, which is called the cash flow prediction model. It's going to be a very, very big section. I'm going to be showing you how to prepare, say, a 12-month rolling cash flow forecast. And to be quite honest, that's going to be coming up for almost for the rest of this money management course, which is going to be a really big section, to be quite honest. Yeah. So go ahead now, do this exercise, and I will see you on the other side. Thank you, and then speak soon. Bye bye.